Welcome back to Stock Spotlight. I'm your host, Michael. Today's episode is a little different. This is not a standard company deep dive, and it is not meant to be the final word on the company. This is more of a special situation preview for one of the most interesting upcoming spin-offs in the market. The company is Honeywell Aerospace, expected to separate from Honeywell on June 29th under the ticker HONA. I wrote about this recently on Substack because the when-issued shares are already giving us a useful valuation signal before regular way trading begins. But the share price alone is not enough. The better question is, what market cap, enterprise value, and EV to adjusted EBIT multiple does the when-issued price imply? And then the more important question is, does that implied valuation make sense for a standalone aerospace and defense systems company? So today I want to talk about three things. First, why spin-offs can create opportunities. Second, what Honeywell Aerospace actually is as a business. And third, what the current valuation seems to imply before the spin. As always, nothing here is financial advice. This is just my research process. Let's start with spin-offs. Spin-offs have a strong reputation among special situation investors because there's a long history of research suggesting that they can outperform over time. Stock spin-off investing summarizes several studies on this. A JP Morgan study of 231 spin-offs and carve-outs from 1985 to 1998 found that spin-offs outperformed the S&P 500 by 11.3% in the first 18 months of trading. A Credit Suisse study covering 1995 to 2012 found that spin-offs outperformed the S&P 500 by 13.4% in the first 12 months after the spin-off date. Deloitte and Edge Consulting also looked at spin-offs from 2000 to 2014 and found that they generated a 22% return in their first 12 months, outperforming the MSCI World Index by 21%. So that's the attractive part. But there is a big caveat. Spin-offs do not work automatically. The same research also points out that many spin-offs underperform and some fail badly. So the point is not that every spin-off is a buy. The point is that spin-offs can create temporary inefficiencies because the shareholder base is changing. Some investors receive shares in a company they never chose to buy. Some index funds may not be natural holders immediately either. Other funds may be constrained by size, liquidity, sector, or mandate. And some shareholders may simply sell because the new position is too small to matter. All of this can create selling pressure that has nothing to do with the business quality. S&P Global also maintains the S&P US Spin-off Index, which tracks US companies spun off from a parent company within the last 4 years, and this is subject to a minimum float adjusted market cap threshold. I think that is useful here because it frames spin-offs as a distinct category, not just random corporate events. But for Honeywell Aerospace, I would be careful not to overdo the forced selling argument. This is not a tiny orphan spin-off that no one can own. Rather, they are a large-scaled, investment-grade aerospace and defense company. So yes, there could be technical selling around the spin. But this is not the classic setup where a tiny business gets dumped into the market and ignored. This is more of a high-quality pure play coming out of a large industrial conglomerate. That is why I think the bigger question is not whether there is selling pressure in the first few days or months. The bigger question here is whether Honeywell Aerospace deserves to be valued like old Honeywell or like a premium aerospace pure play. Now, let's talk about the business. Honeywell Aerospace is a leading supplier of mission-critical aerospace and defense systems. The company had $17.4 billion of 2025 net sales and $4.3 billion of 2025 adjusted EBIT. The revenue mix is balanced across three big end markets: commercial aftermarket, which was 44% of 2025 sales, defense and space, which was 41%, and commercial original equipment, or what we'll call OE, which was 15%. And that mix matters. Commercial OE gives the company exposure to aircraft production growth. Defense and space gives it exposure to modernization, missiles, electronic warfare, space, navigation, and global defense spending. But the commercial aftermarket is where a lot of the business quality really shows up. The aftermarket business had $7.7 billion of 2025 sales, 12% organic growth, and 65,000 in-service fleet. Honeywell also says roughly 10% of total sales come from RMUs, which stands for retrofits, modifications, and upgrades. Those RMU sales compounded at roughly 18% from 2021 to 2025. That is important because RMUs are not just traditional maintenance. They are upgrades that can add new capabilities to existing aircraft and systems. That can include safety, efficiency, connectivity, software, power, and performance upgrades. In other words, the installed base is not just a maintenance annuity. It can also be an upgrade platform. That is one reason among many why I think HONA is more interesting than a basic aerospace parts supplier. The company also has broad aircraft content. Honeywell says around 90% of in-service aircraft have HONA content. It also has content on more than 250 in-production platforms. If you look at the segment mix, it is also pretty balanced. Electronic Solutions did $6.8 billion of 2025 sales. This includes avionics, navigation, and sensors, electromagnetic defense, space, and software. And then Engines and Power Systems did $5.4 billion of sales, and this includes engines, auxiliary power units, and aircraft power systems. And Control Systems is the smallest at $5.2 billion of sales, and this includes air and thermal control, motion control, braking systems, engine start systems, cabin pressure systems, and other mission-critical components. Honeywell says more than 75% of commercial flights begin with the HONA engine start system. So this is clearly a company with a broad aerospace systems portfolio. And that leads to one of the most important phrases from their Investor Day presentation: develop once, deploy everywhere. The idea here is that Honeywell can develop core technologies and then use them across commercial airport, across commercial transport, business aviation, defense, and space. That matters because it really can improve R&D returns. Instead of building a one-off technology for one customer or one platform, they can use technology across multiple aircraft types and markets and applications. That is the business quality case in simple terms. It has scale, they have recurring aftermarket exposure, and embedded content on lifelong aerospace platforms, and a growing RMU opportunity. And it has a management team that's arguing that standalone focus should improve speed, capital allocation, and accountability. Now let's turn to the valuation. In my Substack article, I backed into the implied HONA valuation using the when-issued quote. The distribution ratio is expected to be 1 HONA share for every 2 Honeywell shares. Honeywell's trailing 12-month share count as of Q1 26 was roughly 639 million shares. If you divide that by 2, you get around 319.5 million HONA shares. Now, when I wrote the Substack article on June 19th, the when-issued price was $277.24, which implies equity value of about $88.6 billion. Note that as of recording of this podcast episode, the when-issued price dropped to $271, which implies an equity value of around $2 billion lower, or $86.6 billion. If I keep the same estimated net debt assumption of $15 billion, the implied enterprise value moves from roughly $103.6 billion to about $101.6 billion. And using the same 2026 expected adjusted EBIT midpoint of $4.7 billion, the implied EV to adjusted EBIT multiple moves from 22x to about 21.6x. So the stock has moved a little lower since the article, but the conclusion does not really change. HONA is still being valued like a high-quality aerospace asset, not like a discarded spinoff. Now we need peer context. Now let's bring in some peer context. At roughly 22x 2026 expected EV to adjusted EBIT, HONA looks meaningfully above Honeywell's long-term historical EV to EBIT average of 16.7x, and their median was closer to 14.1x. Now, that comparison is not perfect because I'm comparing HONA's forward EV to adjusted EBIT to Honeywell's historical EV to EBIT, so I would mostly treat it as a directional sanity check. For current aerospace peer context, GE Aerospace is trading at around 39x EV to EBIT as of June 22nd, while TransDigm is trading at around 22 to 23x EV to EBIT. Again, this is not a perfect comparison, but it does help frame the debate. At roughly 22x, HONA is much closer to TransDigm than GE Aerospace. That makes sense to me directionally. I do not think old Honeywell's historical multiple is the right anchor because HONA will be a cleaner aerospace and defense pure play. But I also don't think HONA automatically deserves the same multiple as GE Aerospace, as they have a very specific engine aftermarket profile that the market clearly loves. Management's long-term financial framework is important here too. By 2030, Honeywell Aerospace is targeting 6 to 8% organic sales CAGR, adjusted EBIT above $6.5 billion, and free cash flow of $5.6 billion, according to Wolfe Research. If that framework is credible, then the question becomes, what should I pay today for a company that could do more than $6.5 billion of adjusted EBIT by 2030 with free cash flow above $5.6 billion? That is the real bull case. But there are a few risks here to talk about. The first is that valuation already reflects a lot of the quality. At 22x, this is not being given away free. The second is leverage. The company is expected to start with a cash to debt ratio of roughly 0.06x. That is well below what I usually like to see of around 0.75x, or at least at or above their industry median, which in this case, aerospace is 0.97x on Guru Focus. The offset to this is that management is targeting investment-grade credit ratings and strong free cash flow generation. But this is still a clear watch item because HONA is not coming public with some fortress net cash balance sheet. The third risk is supply chain execution. The Investor Day presentation was very clear that supplier and internal constraints have challenged output. Management is trying to turn that into an opportunity by improving planning, expanding supply, and using what they call the Honeywell Aerospace operating system to convert demand into output. With all this in mind, there is one final portfolio question for me. Even if I like Honeywell Aerospace as a business, do I actually need more aerospace exposure? That matters because this is not a decision being made in isolation. If you already own aerospace names like TransDigm, which would be me, GE Aerospace, like my dad, HEICO, RTX, or others, then buying HONA may not be a new theme. But I do think there is a good argument for why doubling up in aerospace right now can make sense, especially if the businesses are truly exceptional. Lawrence Hamtill from Fortune Financial wrote a great piece on aerospace as an industry in 2025, and his basic argument is that aerospace has historically combined several traits that investors usually love: long duration growth, regulatory barriers, high switching costs, long product cycles, and meaningful pricing power for suppliers. He also points out that aircraft have extremely long lives, production runs can last decades, and certified aerospace components can remain economically relevant for a very long time. That is what makes the aftermarket so powerful. If your part is on the craft and the aircraft keeps flying, the revenue opportunity can last for decades. That connects directly to the HONA thesis. Honeywell Aerospace is not just selling into one aircraft cycle. It has content across a large installed base and long-life aerospace platforms. So while adding HONA could increase my aerospace concentration, that may not be a bad thing if the industry structure is genuinely attractive. So what am I watching after June 29th? First, where the stock price opens relative to the when issued price. Second, whether there is technical selling in the first several trading days. Third, trading volume, because in spinoffs, volume can help show whether the shareholder base is turning over. Fourth, the final capital structure and management's early capital allocation priorities. And finally, fifth, whether the company begins to earn investor trust as a standalone public company. In short, Honeywell Aerospace is a high-quality aerospace and defense systems company coming public through a spinoff at what looks like a fair starting valuation. That to me makes it worth watching, but it also means the investment case must be earned through execution. Thanks for listening to Stock Spotlight. If you want the full valuation bridge, I posted the math on Substack, including the implied share count, equity value, enterprise value, EV to adjusted EBIT multiple, and scenario table. As always, the goal is not to predict perfectly. The goal is to understand what the market is already pricing in, where the debate really sits, and what could have to happen for the investment to work. Next episode, I'll be putting NAPCO Security Technologies, ticker symbol NSSC, under the microscope. If that's on your radar, make sure you're subscribed so you don't miss it. Until next time, keep your process sharp, your standards high, and your portfolio intentional.